Welcome to a new video from New Way Finance Academy. Today, we dive into the world of mutual funds. Now, you might be wondering, what exactly is a mutual fund? Well, think of it as a big pot of money, contributed by many investors just like you. This pooled money is used to purchase a variety of securities, such as stocks and bonds, giving you an opportunity to diversify your investment. What makes mutual funds stand out? They're managed by seasoned professionals known as fund managers. These experts meticulously analyze market trends and make investment decisions on your behalf, aiming to get the best possible returns. So essentially, a mutual fund is a collective investment vehicle that allows you to be part of a diversified portfolio managed by financial professionals. Quite interesting, isn't it? Before we proceed, please like this video, subscribe to New Way Finance Academy, and turn on notifications to stay updated. Mutual funds can seem complex, but they're based on a simple concept. At their core, mutual funds are about pooling resources. Imagine a group of friends coming together, each with a unique skill. One is a fantastic cook, another has a knack for entertainment, and a third is a whiz with numbers. Together, they decide to run a successful restaurant. Mutual funds operate on the same principle. Investors pool their money together to form a mutual fund. This pooled fund is then invested across a wide range of assets like stocks, bonds, and other securities. The idea is to spread out the risk and increase the chances of earning a profit. This is called diversification, and it's one of the key features of mutual funds. Think of diversification as not putting all your eggs in one basket. If one of the investments doesn't perform well, the others can compensate for it. This way, even if a few sectors or companies don't perform well, the overall portfolio can still remain profitable. Now, managing a diversified portfolio requires expertise and time. That's where mutual funds shine. They offer professional management. Each fund has a manager or a team of managers who makes investment decisions based on extensive research and analysis. They track the market trends, evaluate the performance of different sectors, and adjust the portfolio to maximize returns and minimize risks. Another great advantage of mutual funds is the ease of investment. You don't need a large sum of money to start investing. Even with a small amount, you can buy a piece of a large diversified portfolio. It's like buying a slice of a large pizza instead of the whole pie. In a nutshell, mutual funds bring together the power of diversification, the expertise of professional managers, and the convenience of easy investment. They allow investors, big and small, to participate in the financial markets without the need to manage individual stocks or bonds. Mutual funds are thus a convenient and efficient way to invest in the financial markets. Mutual funds come in different flavors, each designed to meet specific investment goals. Now, let's delve into the main types of mutual funds. First up are equity funds, also known as stock funds. These are the most common type of mutual fund. They invest in stocks and their primary goal is long-term growth. If you're looking to build wealth over time and can handle some ups and downs in the market, equity funds might be a good fit for you. Next, we have bond funds. These funds invest in bonds, which are essentially loans that companies or governments sell to investors to raise money. When you invest in a bond fund, you're essentially playing the role of the lender. The return on your investment comes from the interest that these entities pay on their loans. Bond funds can provide regular income and are generally less risky than equity funds, making them a popular choice for conservative investors. Then there are money market funds. These are the safest type of mutual funds and invest in short-term, high-quality investments issued by U.S. corporations and governments. Money market funds strive to maintain a stable value of $1 per share and can provide a safe haven in tumultuous markets. They are ideal for conservative investors looking for a place to park their money. But mutual funds don't stop there. There are also specialty funds, which focus on specific sectors like technology or healthcare. They offer a way to invest in a particular industry without having to pick individual stocks or bonds. Index funds aim to match the performance of a specific market index. They are a type of passive investing, which means less work for fund managers, and consequently, lower fees for you. Balanced funds, also known as hybrid funds, invest in a mix of stocks and bonds to create a balanced portfolio. They can offer a one-stop solution for investors looking for diversification. Choosing the right type of mutual fund depends on your investment goals and risk tolerance. So, take some time to understand these different types of mutual funds before making your investment decision. Now that we've covered the basics, let's see how mutual funds work. Picture this. You've decided to invest in a mutual fund. The first step is to buy shares. When you invest your money in a mutual fund, you're essentially buying a piece of the pie. Each share represents ownership in the fund and the income it generates. Now you might be wondering, how does the fund generate income? Well, the answer lies in the fund manager. The fund manager is a financial professional who makes investment decisions on behalf of the mutual fund's shareholders. They use the pool of money from investors to buy a diversified portfolio of stocks, bonds, or other securities. Their primary goal is to generate returns for the investors. The fund manager's decisions can lead to two types of returns: income and capital gains. Income is earned from dividends on stocks and interest on bonds. The fund pays out nearly all of the income it receives over the year to fund owners in the form of a distribution. Capital gains, on the other hand, are the profits from selling securities that have increased in price. The fund manager realizes these gains when they sell these securities. The net capital gains are then distributed to the investors. Of course, investing is not just about buying and holding. There may come a time when you decide to withdraw your investment. This is called redeeming your shares. When you redeem your shares, the fund must pay you the net asset value, or NAV, for each share. The NAV is calculated at the end of each trading day and represents the value of all the fund's assets minus liabilities, divided by the number of outstanding shares. So, there you have it. Investing in mutual funds is a dynamic process that involves buying, holding, and selling shares. The fund manager plays a crucial role in this process, making investment decisions to generate returns for the investors. It's an ongoing cycle of buying shares, earning returns, and redeeming shares. Investing in mutual funds is a dynamic process that involves buying, holding, and selling shares. Like all investments, mutual funds come with risks and potential returns. Mutual funds, despite their many benefits, are not without their share of risks. One of the most prominent risks is market risk. As the value of securities fluctuates due to market conditions, so too does the value of mutual funds. It's the same old rule. As markets rise, your investment value climbs. But when markets fall, so does your investment. Another type of risk is credit risk. This comes into play when the fund invests in corporate bonds or debentures. If the company issuing these bonds faces financial difficulties or, in the worst-case scenario, goes bankrupt, the investment can suffer. Essentially, credit risk is the danger that a borrower will default on any type of debt by failing to make required payments. We also have liquidity risk. This is the risk that an investor will not be able to sell or buy securities quickly enough because there aren't enough buyers or sellers in the market. While mutual funds are generally considered liquid investments since they can be bought or sold on any business day, certain circumstances can limit this liquidity. Now, let's talk about potential returns. The returns on mutual funds are directly linked to these risks. As a rule of thumb, higher the risk, higher the potential return. This is because investors need to be compensated for taking on additional risk. For instance, equity funds which invest in stocks have a higher risk compared to debt funds which invest in bonds, but they also offer higher potential returns. It's important to note that the key word here is potential. Returns are not guaranteed in mutual funds. The market might surge, leading to substantial profits, or it might plummet, resulting in losses. To sum up, mutual funds are a potent investment tool, but they come with their share of risks. It's crucial to understand these risks and the potential returns before investing. Understanding these risks and returns can help you make informed investment decisions. The world of mutual funds may seem complex at first, but with knowledge and understanding, it becomes a powerful tool in your investment arsenal. Thank you for joining us today on this journey through the world of mutual funds. Remember to like, subscribe, and turn on notifications for more finance insights from New Way Finance Academy.